Hi and welcome to Swissquote's Daily Market Talk. It's Friday, July 4th. The S&P 500 and Nasdaq closed their holiday shortened week at fresh record highs as the latest US jobs data printed stronger than expected headline figures. But trade and debt worries are back. The US yields are pushing higher. The trade agreements between the US and partners suggest that the tariffs won't go much lower than what Vietnam obtained, and the Trump's big and fat tax bill is yet to be digested by global investors. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. It's another day, another record high for the S&P 500 and Nasdaq 100 indices, while the Dow Jones Industrial Index is just a few points from its own all-time high level. The small and mid-cap stocks in the US are also better bid, although they are not yet near their post-election high levels, and all that optimism in the market despite a set of stronger than expected NFP and employment data released yesterday in the US that literally smashed the possibility of a July rate cut from the Fed from near 27% before the data was released to around 5% posterior to it. So the US 2-year yield that best captures the Fed expectations spiked more than 10 basis points to 3.90% level yesterday, and the 10-year yield surpassed the 4.35% mark. The US dollar rebounded. Now the markets are going to be closed in the US, but if you are surprised to see the rally extend after the data, you were not alone yesterday, and that could be a concern. Because diving a bit deeper into the data, yesterday's US job data wasn't even as brilliant as the headline figures suggested it was. The US economy sure added 147,000 new non-farm jobs, which was better than expected, but a big chunk of that number came from public education employment. That is not necessarily a sector hinting at sustainable growth. Then unemployment rate in the US unexpectedly fell from 4.2 to 4.1%, while the expectation was a rise to 4.3%, but it's mostly because around 130,000 workers left the US labor force. So these numbers were not as brilliant as they looked at the first glance. On the other hand, however, and we were talking about it in, this week's previous episode in the comments session, the revisions to last month's jobs figures from the US surprised to the upside and not to the downside, which we did not expect, obviously. And the wages growth actually slowed more than expected by analysts last month. The average hourly earnings fell on both monthly and yearly basis toward the slowest level since last summer, which is obviously soothing news for the Fed and the Fed does, and the Fed's inflation battle. But it's just that this time it's not the wages pressure that threatens to fuel inflation in the US, but it is the tariffs and the agreement that we saw this week between the US and Vietnam on the trade front, which resulted in 20% tariffs for Vietnamese goods that are going to be exported toward the US and 40% if they are being transshipped through Vietnam, gave global investors an important hint on the level of tariffs that you should be expecting from the latest negotiations that are going to land on the market in the coming days starting from today. So the tariffs won't settle near the 10% universal level, but will probably be higher than that. And that will, at some point in time, show up in inflation figures in the US unless companies decide to take on the full cost of these tariffs on their shoulders. That is a possibility, mind you, especially in the short run, because some companies actually prefer to eat the tariffs, as would say Donald Trump, to protect their US market share. But how long they could do that remains to be seen. It's just a short-term strategy and not a viable one. For now, Trump is reshaping the global trade dynamics, that's for sure, and they will likely be inflationary for the US in the medium run. On the other hand, Trump successfully passes 3.3 trillion US dollar worth of beautiful tax bill. I call it the reverse Robin Hood tax bill, actually, that will take from the poor and give to the rich in a tight, Congress vote. Trump is now set to be signing the bill this afternoon on the Independence Day, guys. It is a brilliant show, mind you. Now, of course, the fact that the fat bill will beautifully push the US national debt past the 40 trillion US dollar mark in a few years from now is a major worry for global investors that may eventually decide not to finance it. The UK knows the problem quite well, and the latter could renew pressure on the US long maturity papers and yields. And if that's the case, we could eventually see the risk appetite in the market dented in the coming days and weeks. And given the high and barely justified market rally of the moment, the probability of a market sell-off increases by the day. And these risks include debt risk, trade risk, geopolitical risk. So the US debt markets are closed today, but gold is back above its 50-day moving average level this week and is pushing higher this morning on the back of trade unease and US debt concerns. The futures, the US and European futures, are in the negative this morning at the time I'm talking here. So I think that the week will probably end on a cautious note as investors await the US tariff rates to be revealed starting from today, according to the latest news. So the suspense is killing everyone, and the chances are that they will not please. Will that matter for investors is yet to be seen, however, because the news flow today tend not to result in predicted market reaction, and that's a cause for concern per se, because when valuations are so high, well, you would expect a good and strong fundamental news to back these valuations. In the FX markets, the US dollar is back to giving back some of yesterday's gains on trade and debt worries. The euro dollar consolidates a few pips below the 118 psychological mark, while cable is better bid on relief that Rachel Reeves will remain in place as UK's chancellor and not be replaced by someone who would spend big and more than they could take on, despite narrowing fiscal headroom to help the Labour realize their welfare dreams. So the mini stress that we saw in the gilt space this week has been rapidly contained. That's good news for the UK, but note that the UK 10-year gilt yield still remains at levels that were reached during Liz Truss mini budget crisis, and the high borrowing cost for the UK is obviously a drag for growth expectations and could eventually limit sterling's upside potential. While the dollar yen in Japan pushes lower this morning on the back of a stronger yen after the annual wage negotiations in Japan ended with a 5.25% increase for average wage in Japan, which is a huge number for Japan that's used to deflation. So that's the highest level in 34 years, guys, while household spending jumps, cementing the hawkish Bank of Japan expectations. So Nikkei is down this morning on hawkish BOJ bets and trade uncertainties with the US. Elsewhere, US crude consolidates this week's gains near the $67 per barrel level. Now, bears are in charge of the market this morning on news that the US and Iran nuclear talks will begin again next week, and that OPEC Plus will certainly bring 411,000 more barrels per day in the market to restore production in a faster fashion. So that's a decision that is expected to be announced this weekend on July 6th. So while the higher supply and uncertain global demand outlook remains in favor of the bears in the medium run and would obviously justify a return of the barrel of US crude below the $65 per barrel level, this week's strong support near this level actually hints that the latter could eventually take longer than previously thought. So this is all for this week. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again next week, and until then, good day trading and have a lovely weekend.